Okay, well, good morning, everyone. Welcome to the AssetCore Debate. I've got good news and bad news to start with. The good news is that if there were such a thing as a rock and roll Hall of Fame for social housing regulators, our two guests today would feature very highly. I think they'd be in the main exhibit hall. The bad news is we've only got them for 30 minutes, so you're going to hear more of them and less of me, as I'm sure you wish to do. Very briefly, by way of introductions, I'm Phil Jenkins. I'm Managing Director at Centrus and also a board member at AssetCore. Julian Ashby is the Chair of Paradigm Housing Association and of AssetCore. Until 2018, Julian was the Chair of the Social Housing Regulator for 6 years and a board member of Homes England, and prior to that a managing director of Haycast Chapman Hendy and chair of Haycast Group Limited. He makes me look like a mere pup with over 40 years of experience in the social housing sector. Simon Dow has been interim chair of the Regulator of Social Housing for the last 2.5 years. He's also executive chairman of the London Housing Foundation Limited, and prior to that spent a very successful, I believe, 14 years as CEO of the Guinness Partnership. So we're delighted to have two illustrious speakers with us today. There's obviously a huge amount going on in the world and in the social housing arena at the moment, and so Julian first and then Simon are going to really sort of share their perspective. Julian from a probably more of a housing association perspective, given his role at Paradigm, and then Simon from a regulator's perspective. So the plan is for them to give you a sort of 5-minute or so introduction on their current thoughts, and then we'll be very happy to take questions and move into a discussion. There is a question mark symbol that you can hopefully see on your screens for you to submit written questions, which is the format that we'll be using. So please, let's make this as sort of interactive as possible, and let us have your questions, and we will hopefully get to them later on in the session. But with that, I'll hand over to Julian.
Okay, hello everyone. There's a certain irony in a Tory government pumping money into the economy at a rate never seen in peacetime, but this is clearly set to continue at scale. Less clear, I think, is whether pragmatic populism will win out over instinctive ideology, and the mini budget offered little to the social sector. In short, I think we'll have to wait until the autumn statement to judge the likely impact on us, and by then, hopefully, we'll have a better idea of the Brexit outcome. As we stress test our business plans for this new world, we do need to take account of two pre-COVID issues that were coming centre stage until they were eclipsed. The first is the cost of remedial works to high-rise blocks. The initial focus was on ACM cladding, but there are many more blocks with HPL cladding which can be just as unsafe. So many associations still face huge remedial costs. The problem is exacerbated by two complex factors. First, most recent fire surveys have revealed a host of other problems, often including compartmentation failures. And addressing these and adding other fire safety features like sprinklers can add 50% to the cost of cladding replacement. The second issue is that many tower blocks are multi-tenure, and leaseholders may in theory be liable for their share, but this can be completely unaffordable to them. The second major pre-COVID issue is the cost of achieving zero carbon by 2050. Savills have estimated that the average cost per unit of getting around 80% of the way there will be £17,000 per home, and that's above whatever you've put into your planned component replacement already. So I guess we're going to have to factor that into our business plans too. The government has yet to set a trajectory, but fuel poverty regulations will require EPCC by 2030, and this may become part of the new Decent Homes 2 standard. Getting a handle on these two issues of fire safety and decarbonisation is typically hampered by two factors. First, there's a continuing policy vacuum over what is required by when and what level of government support might be available. The second factor is that few of us have the level of detailed data on our stock that is necessary to plan the programme. On the face of it, none of these additional costs generate additional income. If the resulting net present value is negative or very low, then this raises basic questions of whether it would be better to redevelop or sell. But both these options raise many further complex issues. Returning to the direct impact of COVID on business plans, this is obviously mainly in two areas, rent loss and development. 4 months in, most of us have experienced an increase in arrears, but this is still very early days. Many employers in vulnerable sectors are preempting the furlough extension by announcing redundancies, and unemployment is likely to rise sharply for some time. And while universal credit will take the strain, there is going to be transition pain, and that is what will transfer into rent arrears. In the longer term, the other unknown is whether a government under increasing financial pressures will renege on the rent formula for a second time. For those with development programmes, COVID presents a more immediate challenge. So there are issues of declining prices and sales rates, both for schemes on site and already completed. And then there are dilemmas about whether to continue with uncommitted programmes and what to do about any land banks. Taking all these factors together, what gives? We can hardly slow down maintenance spend when there is already a lockdown backlog to be tackled. And after 4 years of rent reduction, we don't have much fat left in the system that can be shed painlessly. So scaling back development is a likely strategy given the market uncertainties. But I think there will still be substantial opportunities for those with cash. Some developers are already offering discounted package deals, and if the downturn looks to be more severe, then there may be distressed sales of property and land. But I think there's also going to be a renewed focus on rationalisation, both through stock swaps, disposals and mergers. The experience of home working will lead to new business models for service delivery. Offices are unlikely to be a thing of the past, but full-time office-based working is likely to diminish, and this opens up further rationalisation opportunities. Many associations have, like us, put extra resources into contacting vulnerable tenants, and this has gone down very well. So many of us have experienced increased tenant satisfaction in spite of only providing an emergency maintenance service. And this indicates that a higher level of resident engagement, combined with more online access, has the potential to break the old mould of service provision. So for me, the biggest opportunities are in stock rationalisation and the ability to do business differently. So that's my opening remarks. So I'll hand back to Phil and Simon.
Great, thank you very much, Julian. And just a reminder for anyone wanting to ask questions, please do submit them into the chat through the question mark symbol. So thanks, Julian, and over to you, Simon.
Okay, thanks, Phil, and good morning to everyone. And thanks to Julian for a typically thoughtful assessment from a thoughtful organisation. So I've been asked to give a quick view from the regulator about what our assessment is of the range of issues that associations are currently facing. I'd be very surprised if any of the people who have checked into this webinar will find any of this particularly surprising, but I think packaging them together gives a sense of the scale of the challenges that associations are going to face. But let's start with some good news. As you all know, the regulator has carried out a cause survey monthly for the last few months, and we've just received the first set of data for the last month. It hasn't yet been published, but I can give you a quick look at it, a quick glimpse of what's going to come out. Once again, we had a very high response, 99%, and the response showed very high levels of reported compliance with emergency repairs, gas checks, statutory fire checks, other health and safety checks, and crucially and very pleasingly, care and support services as well appear to be coping magnificently with what's being thrown at them. So that's a very good starting point. The core survey, of course, as you all know, is mostly about resident services of one sort or another. Financial data comes in through different sources. So as I say, a really good place to start. As Julian has indicated, some very positive responses from residents. But associations also face some immediate pressures. Julian's mentioned sales income. We don't know yet of the impact of stamp duty, and whether that will actually reflate the market and help associations. But also we've had a significant number of reports from associations on the need to actually increase tenant services around a couple of areas: antisocial behaviour, perhaps not too surprising, but also domestic violence, where there has been a significant increase reported, and most associations are trying to respond to that. Okay, over the next few months, Julian's made the point about investment dilemmas, fire safety, obviously a top priority, carbon zero now needing to go into business plans, new supply. Julian mentioned, of course, that you've had 4 years of reduction of rents. Of course, you've also got a much more generous rent agreement that's coming into place very shortly, and the reality of that is, or coming through very shortly, the reality of that is that the government put that in place in order to increase new supply. So we need to be very conscious of the fact that they feel that that's their side of the bargain. You can also expect increasing vulnerability of residents, as Julian said, through unemployment and rent arrears. And then he also referred to the problem of leaseholders and fire safety certification, which I think is going to grow really a serious problem with organisations and not being able to allow associations to actually, residents to move easily, and making a number of them feel trapped in quite expensive accommodation, particularly if they're having to pay for walking watches. You're also going to be coping, and I think this is a positive, with a new arrangements with the Ombudsman, a new working protocol with the Complaints Handling Code. But as I say, I think that's going to help things along. Whether or not you feel that the RSH and the fact that we'll restart our IDAs is as helpful as that, I don't know. But actually, interestingly, a number of associations have actually volunteered to rejoin our IDA programme. So that's over the next few months. That's the next few months. So over the next 12 months, well, obviously associations will be more than aware that the government has published a building safety bill, and you will get a new regulator, probably part of the Health and Safety Executive, and their requirements for information and also potentially action will make a major impact on business plans as they start to emerge. You've also got, I think, there's a reasonable likelihood of a white paper in the next few months, which will heighten the consumer focus and bring new responsibilities for RPs, and also for the first time for local authorities, which will be a major challenge for the RSH in particular. And then, of course, the third thing that's in the offing is a new homes ombudsman, and I'm afraid associations have not been completely free of problems with quality of new homes. So the new homes ombudsman will actually make a bit of an impact on life for at least some associations. And finally, of course, the Grenfell inquiry, which I know has paused as of today, but will restart in the new year, always has the potential to actually throw up new challenges. Put all of those together, they represent a pretty serious set of issues for associations to have to deal with. The good news is that in the past, associations have shown themselves as very much having the skills and the experience and the appetite to deal with a range of challenges and to find a way through. So let's hope that that remains the case. I'll stop at that point, Phil.
Great, thank you very much, Simon. We have a question here which I think links through to one of the points you made there, Simon, about the new ombudsman in relation to new stock. And the question was from Tom Jarman, asking about the prospects now for a move away from investment driven by sort of basic regulatory requirements, and and this I suppose feeds into the whole decarbonisation agenda as well. And I'd like to ask you and Julian, I mean, there are these various competing issues around at the moment. You've both mentioned safety is obviously quite rightly being very high on the agenda. We've also got the whole decarbonisation agenda and green recovery, and then we've got the ongoing supply crisis. So Julian, maybe I'll ask you first, from your position as a chair of a housing association, how on earth do you start to sort of manage those different priorities and competing priorities for finite resource within a housing association and public sector context?
Well, I think the first priority is a bit of a no-brainer, in the sense that I think health and safety always has to come first, as our first duty is to the safety of our existing residents. I think it then slightly depends on how the government decides to handle climate change. I think the likelihood in due course is that there will be a specified trajectory, and that might be enshrined either in the minimum energy efficiency targets, which apply to the private rented sector, or it might be through decent homes too. But if it effectively becomes a legal requirement, then we have a legal responsibility to make sure that we have set aside the resources that are to undertake and fulfill that. But that's not immediate well, when I say it's not an immediate priority, because the government hasn't set a trajectory yet, we're still kind of working up our plans to how to address possible targets. We do have funds available for development, but how many homes that will stretch to will ultimately depend on whatever grant settlement is announced in the next programme. And if it's one that doesn't provide much for rented housing, then it will be significantly less than if it's and if it assumes a pre-COVID level of cross subsidy from sales, then it will be less. But I do think everything will depend on what Homes England are allowed in due course to announce after the autumn statement.
And Simon, what when with your regulator lens on, when you look at those competing priorities, how does that sort of feed into your assessment of sort of governance and financial viability? Because at some level, I imagine the financial viability question is one for the housing associations themselves to address what they can achieve across all of these areas and what's statutory and what's optional. But how does the regulator sort of see the juggling of those different priorities?
Okay, well, my response isn't very different from Julian's, which is that fire safety is clearly, in most cases, a clear legal, and in other cases, a very strong moral argument. And from the regulatory point of view, we would always want to encourage associations to ensure that they comply both with the law, but also their clear moral obligations as well. Once you get past that, and that is, as Julian said, a no-brainer, and I don't think anybody is pushing back against that. But as Julian said, once you get past that, you get into much more murky waters. The whole business of complying with the zero carbon agenda is pretty complicated, as was indicated earlier on. Obviously, some associations are wondering whether or not the stock that they've got is simply unfeasible when it comes to putting proper zero carbon arrangements in place, which then gives them the job of deciding what to do with that stock, and as others have pointed out, simply selling it, and therefore selling it into the private sector, actually simply shifts the problem from one to another. What I would say is that associations have got to try and find a way through all three of those agendas, or certainly having obliged themselves to make sure that they deal with the fire safety, explaining what they're doing on new supply and carbon zero. And the only advice I would give is that those difficult dilemmas are exposed and explained in a transparent fashion, both to stakeholders, whoever they are, whoever wants to beat a path to your door. You should be able to explain where you're putting your resources. And secondly, to government in a very kind of clear and downbeat fashion, so that it doesn't come across as yet another requirement for money, which obviously they're facing at the moment, but a clear exposition of what bangs you will get for your buck if actually Homes England or other programs are able to give associations the source of funding that they need. And it's not just about funding, as we've discussed with other CEOs. It can be about something like end-use flexibility. At the moment, you're putting stuff on site, you don't really know whether it's going to be best as shared ownership, as rented housing, social rented, affordable rented, and it may be that it's not just about the amounts of money that's available, it's about the flexibility about deciding what end use. What I would say is the point that I made earlier on is that government feels that it's given, in their view, a generous rent settlement in order to improve the supply agenda, and therefore we have to address that legitimate aspiration. And if associations feel, quite rightly, after going through all of their exercises, that it's not something they can meet, they need to explain why government will not get what it's wanting to have as a result of that rent settlement.
Mm-hmm. And Simon, this probably leads on to in some way to another question that we've had from Paul Mote at NCHA. Where does the regulator currently sit on V2 as the new normal, and what steps will the regulator take if they move to this new position?
Look, I would be, we were already on a journey to try and make V2 a legitimate financial grade. We don't feel, as you know, quite the same at all about G2s. We think all associations should be heading towards a G1, if not actually there already. But we recognise that in order to push their balance sheets, in order to stretch their business plans, some associations will become V2. Now, if and that's always been the case now for a year or two. Now, if as a result of this COVID crisis, no association moves from V1 to V2, it would be a very odd result. And it would actually give an odd message to government. And I can't see that there aren't going to be quite a few associations who quite honestly look at their business plans and give us the data that makes us decide that they're no longer quite as resilient as they were, and that they are now a V2. That is not a badge of shame. That is actually a perfectly rational response to a very difficult situation, and you could argue it's the right response in many cases as associations stretch themselves in order to meet the range of responsibilities that was unpacked so thoroughly by Julian.
Thank you. Before I move on to the next question, there was a point that I wanted to raise around liquidity, which is, you're seeing a lot of funding activity in the market at the moment, some of which is what I would describe as opportunistic and pulling forward of funding plans, partly because of rates. You saw, some of you may be aware, there was a new issue yesterday by Platform, which was well under 2% for 35-year money, which is I think probably the lowest coupon that's ever been achieved in for long-term financing. I'll come back to you, Simon, on this to ask sort of whether there's such a thing as too much liquidity from a regulator's perspective ever. But Julian, first, could you give your perspective from a from the HA side, in the sense that how do you view liquidity and carrying more liquidity than normal on an opportunistic basis where rates look very, very attractive?
Well, with the number of risks there are around at the moment, this is clearly a great time to be liquid. But I think the other issue is that holding excess cash is actually quite expensive. You don't get much of a reward for it. So I think it's kind of back to the basics. You need to determine and factor in your expenditure on remediation, zero carbon, development commitments, and if it is your policy, something for more opportunistic asset purchases. You probably want enough funding for, if your normal policy is to have enough forward funding for 18 months or 2 years, then I think it's quite reasonable to push it out to 2 or 3 years. But if you go beyond that, you're just going to end up with a lot of cash on which you will get virtually no interest until such time as it's needed. So I think there's a point at which it becomes risky in itself to have an excess of cash.
Simon?
Okay, well, as you implied, Phil, earlier on, regulators love liquidity, but it does, as Julian said, it comes as a price, and you can end up with some fairly sizable unused facility fees if you start to take on far more than you need. But liquidity is obviously a very sensible thing to have, and we would never push back against that. That's absolutely a decision for associations. I think I would say also 2 things really. One is that the fact that associations are able to borrow at such magnificently fine rates is a real badge of should be a badge of pride to the sector. They are conceived of as highly investable, highly bankable, and long may that last. I think the other thing to say, Phil, you will know that there is an awful lot of money that's trying to find a home that will get a return on it, and that means that from time to time associations will be offered deals that look very, very attractive initially, but perhaps are unconventional and need to be studied extremely carefully before organisations become part of a process of actually allowing people with excess liquidity themselves to find a home in the long run for their funding, which might be in a way sufficiently unorthodox to need very careful handling.
I think you're probably referring there to the shifting of risk onto the housing association as opposed to the funder, which often seems to happen in some of these structures. But thank you both. We've got a question from Francesco Elia, which is what's the biggest long-term opportunity and lessons learned for the sector post COVID-19 in the eyes of the regulator and I suppose from Julian's perspective as well, from the housing association viewpoint.
Do you want me to start?
If you could, Simon, yes, please.
Okay, sure. Well, okay. I think a number of associations, CEOs have said to me that maybe they're getting fonder of stress testing than they once were. So I think there's a lot to be said for stress testing. I think the other thing is that those of us who are fond of risk matrices know that the thing that actually really damages you is the thing that's actually not on your list of risks, and therefore that ability to be able to develop resilience for the thing that you can't spot coming. I think one of my worries, Phil, is that all of us just want to get through this at the moment and get to the other side and take a deep breath. But there's no suggestion, A, that this isn't going to last for quite a long time, or that it couldn't be replaced by something actually pretty difficult as well, albeit something that we wouldn't anticipate. So resilience, resilience, resilience. And I think probably that underscores the point that Julian made earlier on about the need for organisations to look hard at their management footprint and work out whether or not they're going to be able to cope with the next one that comes along, even though it's hard to spot at this stage.
I guess pandemic risk is a new one on risk registers now, but one which will feature. Thank you, Julian.
I think for us, the biggest opportunities are probably to build on our experience of the last 4 months in order to shift to a different business model, and one that is, I mean, we've all been, I think, little short of amazed at how quickly we were able to transform from an entirely office-based business to an entirely home-based business. And you realize that if you put your mind to it, you can actually achieve changes extremely quickly. We are certainly not keen to rush back at the earliest opportunity to the old way of working. And we feel that we've learnt quite a lot of valuable lessons, and we're now taking a step back and thinking, well, what is the future shape of the business? How can we build on that experience? And I think we are going to end up both smarter, more resident focused, more economic, and providing a different quality of service from pre-COVID days. And I think there's a lot of opportunity. I don't think there are necessarily very clear answers as to how to do that yet, but I do think it's a very promising area.
Thank you, Julian. I would echo that. I mean, I think you'll see a lot of businesses that will come out leaner and smarter and more effective as a result of what's happened over recent months. Now, I've got one last question. I would normally ignore it on a time basis, but it's from Derek Joseph, so I don't ignore that. Derek's asking if RPs can borrow at sub 2%, very close to affordable rent yields, is there a development model that generates future contributions rather than requiring cross subsidy, as has been the case over recent years? Julian, quick thoughts on that.
I think it's if I'm understanding the question, that's a sort of, is Derek proposing a sort of private rent market rent model?
Well, I think he's proposing that at sub 2% cost of funds, your cost of funds is sort of matching your affordable rent yields, and therefore is there an opportunity to exploit that in some way?
I think a lot happen for me. I think a lot is going to depend on how the market unfolds. We're beginning to see some upward pressure on development costs and development timescales, which and I think if we crash out of Europe, then that's going to be exacerbated. So I don't think we're about to rush into this. And it seems to me that there are other things that we want to be certain we're going to achieve with the development funding we have available.
I think as well, to give my perspective on that, if you were sort of starting with a blank sheet of paper and you could borrow at sub 2% and build housing that yields similar levels, that does give rise to a sustainable model. But I think in a housing association context, you've got a lot of baggage with you in terms of past gearing and valuations and covenants that actually stop you from matching off your marginal cost of funds versus your fundamental business model. So I think in a certain context that probably holds true, but there's a lot of complicating factors there for other housing associations. I think we're going to have to draw it to a close there. As I said, it was a short canter through. We've already slightly overrun. Thank you very much, Simon and Julian. It's been fascinating hearing your thoughts and perspectives on the current situation that the sector faces and possible future paths. Thank you also very much, everyone, for attending this morning and for participating in a really interesting debate. So we'll wrap it up there. Thank you all, and hopefully catch up soon.
Thank you.
Thanks. Bye.